Hey everyone, my name's Glenn James. I host the This Is Money podcast, and today I'm going to walk you through how you can get into your first home, unit, or apartment without any money down. Well, that sounds really exciting. How do we do it? Well, it's not available to everybody. However, if you've got parents with an existing property, you may be able to use a parental guarantee through your bank or lender. So what I want to do in this short video is walk you through the basic concepts of how a parental guarantee works, so you really understand how it works and get it. But also you might send this to your parents so they can also understand the practicalities of how it works. So let's get right into it. Okay, before we get into the actual parental guarantee, I just want to talk conceptually about deposits with banks and lenders and a thing called lender's mortgage insurance. Now, throughout this video, I want you to remember that we are talking broad concepts. I'll put a link in the show note if you want to speak to a mortgage broker yourself for your own situation and the exact details. But when I learn concepts, and you might be the same, we have to understand the basic principles, and then we can just insert our numbers into the basic principles, because remember, the principles don't change. So what I want to do for the purpose of this video, I'm going to assume it's a single person, but it really, you can use a parental guarantee for a couple, but that's fine. And it probably doesn't even matter for this one. And I'm just going to assume for easy round numbers that they're purchasing an apartment for $500,000. So effectively, if this was, and we'll just use the house for apartments, units, townhouses, whatever, okay? So if the purchase price was $500K and they went to a bank or lender and said, hey, we want to borrow 500 grand for a house. Now, you've got to remember there are three things that you need for a mortgage. The first one is a house. We've got to move into somewhere. The second one is security or a deposit, which we're talking about now. And the third one is your income for servicing the loan. So we'll assume you've found the house, and we'll assume that you've got enough income to service the loans. And this video is just talking about the deposit amounts. What you need to understand, you may have heard out there that you got to save 20% for your first home. So if we wanted to borrow to buy this apartment and it was $500,000, to not pay lender's mortgage insurance, or otherwise known as LMI, when you hear podcasters talk about it, YouTubers, mortgage brokers, you would effectively need to come up with a 20% deposit. So that means you've saved $100,000. You've put the $100,000 of your own money into the property, and the bank or lender will set up a mortgage for $400,000, okay? And you would pay that mortgage off each month. What we need to understand is the reason why 80%, they call that an 80% LVR, and that's a loan to value ratio. So if we look at this situation, the loan is $400,000, the value is $500,000. That loan to value ratio is 80%. So the loan is 80% of the value. If you had an LVR of 100% loan to value ratio, if it was 100, you would have borrowed 100% of the costs. If the LVR was 0, you would not have a loan. So that's an important thing to understand, the loan to value ratio. So we've got our mortgage, $400,000, $500,000 purchase price. Because there is 20% equity in the property, which is your $100,000 that you're put into the property, this is deemed secure for the bank or lender. The reason why they have the 20% as the magical number is if you stopped paying, and we'll use red because red's scary, you stopped paying, the bank can come in, sell the asset to get their $400,000 back or whatever's left on the mortgage. It would be total Armageddon if the property value fell by 20%, but that's what the bank have deemed as what they're comfortable with. So an example, you didn't pay and effectively the bank wanted to knock on your door and say, you haven't paid, we're selling the property to get our money back. Now, if the property had fallen 20% and was now worth 400, they would sell it and take their 400, happy days. Now, let's just have a look at a different scenario using lender's mortgage insurance, and then we'll talk about parental guarantee. So I'm going to draw the same scenario where the purchase price of this unit is 500K. Now, you've saved 10% or $50,000, okay, to put into the property. If we've got an LVR, so remember, loan, which would now be not 400, it would be 450,000. Loan to value ratio would now be 90%. You're in LMI territory. Now, lender's mortgage insurance, anything over an 80% LVR will push you into lender's mortgage insurance territory, LMI. Roughly speaking, the cost of this insurance policy is $10,000 based on this purchase price and this loan. It may vary between banks and lenders, but for this example, we'll use $10,000. And you can borrow that cost. So the mortgage would basically be here $460,000. Okay. Now, what that lender's mortgage insurance does is it's an insurance company out here. And remember, you stopped paying, okay? The money has stopped. The property has fallen down to $400,000. Like we said before, it fell 20%. The bank came in, they sold the property, and you owe them $60,000 because remember, we had a $450,000 mortgage with LMI that was borrowed as well of $10,000. So the $60,000 is the total shortfall that the bank needs to get. Now, because you've got a lender's mortgage insurance policy, the insurance company here, the bank's put a claim in and the insurance company pays what the bank is owed. So you have the privilege of paying an insurance policy to protect the bank from you not paying and them selling the house. Now, if you couldn't pay and they sold the house and it was a couple of years later and the house was worth $600,000 and you still had a $400,000 mortgage, they would just sell the house. Even if they got $500,000, they don't care. They just want to get their $400,000 back and they'll probably spit you out the difference. Okay, so that's what we need to understand when it comes to lender's mortgage insurance and loan to value ratios. Remember, we need three things to buy a house. We need the house itself or the asset. We need security, which is either your own savings, lender's mortgage insurance. There is also a government scheme called the First Home Guarantee where you have to save 5% and then the government will secure the remaining 15% and you can get into your first home. I'll put a link in the show notes to the government website. It's a national scheme and there's different thresholds of the amounts of house you can buy depending on your area, but that just is another option. And then finally, you can use a parental guarantee for security. So let's take a look at a practical example of how a parental guarantee would work. So what we're going to do is we're going to first assume that your income's no issues, you're living in the city, you've got good income, but you don't have much savings and you want to buy your first apartment to live in. The fact that you've got no savings might be another story, but I know it is tough out there and these parental guarantees can really help you get into your first home sooner. If you're in a privileged enough position to have parents that have equity in their house that are happy to help you and or your partner. So let's use the same example of a $500,000 purchase price. So we've got a $500,000 purchase price of the new property. Your parents have a property, and we'll just assume that it's worth $1 million. And we'll also assume that they do not have a mortgage on that property. So effectively, remember, the bank to not pay LMI need to get you at 80% loan to value ratio or under, or at least have 20% security to be in the clear. Now, a couple of other things. Once you have a loan to value ratio under 80%, that's where it really starts to get sharp in terms of interest rates the bank will give. You've got to remember with banking and interest rates, the higher the risk, the higher the interest rate. Remember, personal loans, unsecured debt, the bank might not get their money back at all, so the interest rate's closer to 20%. But when we're talking about home lending, the same thing applies. Anything under 80%, you'll get a better rate than if you had a 90% LVR and paid LMI, or even a 90% LVR and had some money against the parent's property. Let's have a look here. We'll assume we're borrowing 100% of the $500,000 purchase price. So how it works in practice. And we're assuming that first home, there's no stamp duty in the state you're buying this. So the bank will set you up with a loan of $400,000. Depending on the lender, there may be a second loan split. So you log into your internet banking and there are two loans, or there could just be the one $500K loan. And this is why you need to speak to a mortgage broker about your own situation. And that will have a loan of $100K. So the total loan or mortgage that you need to pay each month is $500,000. But what the bank is doing, because there is $1 million worth of equity in your parents' property, there is paperwork that your parents would sign to effectively, and you want to speak to your broker about a limited guarantee, and we'll get into that. Effectively, they are putting up $100,000 of their security for your home. They're not paying this mortgage here. You are. They're not paying this one. You are. You are paying the whole amount, $500,000. However, just in the background, the bank or lender is linking $100,000, or if we look at it this way, the 20% to your parents' property, and then the 80% is linked to your property. So, what happens if you can't pay? And if you talk to many brokers, this is actually a very, very low risk strategy. And I've only ever heard secondhand information of one case in the last 15 years of all the brokers and people that I know, one case where this hit the fan. And I can talk about some strategies to make it more comfortable and secure for the parents. Effectively, if you did not pay, so you stop paying and the bank are like, we're coming to sell the house, kick you out, we need to sell the house and we need to get our money back. If the house was worth, I don't know, let's just assume that the house decreased in value by $50,000, okay? $450,000 unit, but you still owe $500,000. The bank will sell the house, get their $450,000, they'll get the first $400,000 and put towards that, the first mortgage, and then the secured amount of, say, $50,000 is secured against the parent's house. Now, in practice, they would just hit the parents up and say, hey, you've now got a mortgage on your property for $50K. And they might set that up over 20 years. The bank will always get their money. The parents aren't going to lose their house. Now, if the worst case happened and you didn't pay and there was a shortfall and the bank came after your parents for $50,000 in this scenario, I'm sure it's not going to be the end of the world. you might have to just go and get a personal loan and clear that 50 grand and go rent and start again. I don't know. Or just you pay your parents 50K mortgage because it's going to be their mortgage because they put their house as security up against your house. Let's fast forward 5 years later. We'll just assume that you've really got stuck into it and I don't know, there's $50,000 left on that mortgage. You may have had some weird strategy where you're doing interest only on this one and principal and interest on this one because you want to pay the parents' portion off faster, assuming it's a separate split. That's all good. And then down the track, you couldn't pay, but the house that you bought, it's actually increased in value to $600,000. Okay. What would happen then? The bank would come in, sell your property. They've got the 600,000, and because the mortgage is only 450, the bank will get their money back from part of the sale proceeds, and then you walk away with the 150. Your parents' house are never at risk in that scenario because the house is worth more than the total amount of debt. Now, another thing that could happen, if, for example, this house, you bought the unit for $500,000 and it increased in value. You had the best investment property in the world, like you lived in it, and it grew in value to $800,000 in 3 years. Crazy. Australian property style, right? You can then effectively go to the bank and say, we want to remove the parental guarantee. And then because the total mortgage, even if it's $500,000, there's like a 60% LVR. So the parent's loan can be removed anyway. So this is a real low risk strategy. A couple of things that I think we need to double check is understanding the risks for your parents. So the first risk is we want to get a limited guarantee. So that means if the worst case happened and there was $100,000 or $200,000 secured against their house and you didn't pay and your house value dropped, they're limiting it to the guarantee of $200,000 or $100,000 or the 20%, whatever that guarantee is. So you want to make sure it's limited. I would, for best practice, set up your mortgages like I drew. So it's split. So just so you know, you've got the two mortgages. You've got the main mortgage against your house, the guarantee against your parents. Some lenders might not do it that way, but we just want to make sure it's set up that way. Now, on this mortgage, depending on the lender, it may have all four names if there's two parents and a child and an in-law. Another thing you need to look out for is the relationship. I was talking to someone and his wife's parents, his parents-in-laws, had a guarantee over the property they were living in. And it was just, he always felt that it was just a cloud hanging over his head. So they effectively got the house revalued every year and removed the guarantee as soon as possible. And it was a real big focus because you need to have the conversations whether, like if you're using a parental guarantee, are you allowed to holiday? Will you feel guilty going on a holiday if your in-laws or your parents are using their house as security for your house? Is there a weird thing? Why did you spend $5,000 on an international trip? There's a security against our house. Your focus should be to pay that off. So you need to understand the whole, like the spending thing, the relational thing. We want to make sure it's easy to track. We want to make sure it's limited. But the last thing I really want you to do, remember, if you've got your mortgage and it's 400 and it's 100 grand is secured against the parent's house, you're paying for both of these mortgages. We want to make sure that you've got income insurance. So if you stop working due to accident or illness, money will keep coming in to pay the mortgage. So relieves a little bit of financial stress and pressure from your parents. Another thing, finally, that it is still an option if the property that the parents owned was worth $1 million. When it comes to parental guarantees, most lenders will say you can use 70% of equity for their mortgage or a parental guarantee. So that basically means there's $700,000 that can be used. So basically, I don't know, the parents still might have a $500,000 mortgage and they could still use $200,000 as a parental guarantee. But check with the lender that your mortgage broker is considering. But if your parents do have a mortgage, it's not a showstopper. They can still help you. And finally, if the parents don't want to put their house on the line and they have other assets, banks and lenders may be able to, and I know that there's one that definitely do it, the parents may have a term deposit. So this is a safe with a handle, old school safe. The parents may have $100,000 cash that they can put on a term deposit that the bank put a security over for this mortgage here. So there you have it. Parental guarantees, they're not as complicated or as scary as possible. Again, I'll put a link in the show notes if you want to talk to one of the dedicated mortgage brokers that help listeners of This Is Money podcast. They can really help you. Have a chat with them. They will sit down and have a meeting with you, your partner, your parents, together and or separately, and really take the time to explain how everything works. So if you want to understand more about buying your first home or your first investment property, because remember, you can use a parental guarantee for an investment property, John Pidson's new book, Sort Your Property Out and Build Your Future, is available right now. It goes into great detail about the strategies that you need to consider when buying either your first home to live in or your first investment property. And if you do listen to podcasts, you can listen to This Is Money wherever you listen to podcasts. You probably won't because you're a YouTuber. You're watching this on YouTube. But I hope you've learned one or two things. Remember, the 80% LVR rule is the most critical thing to remember when it comes to lending and mortgages. The banks really want 20% of security wherever they can get it from, be it your own money that you put into the property, be it a parental guarantee, be it lender's mortgage insurance, or the government first home guarantee. I'm looking over there because I always forget. Be it that and a bit of your money, or a combination of everything. And this is why a good mortgage broker that can talk to you wherever you're at on your journey can put together and propose the most appropriate solutions for your property. Thanks so much for listening. I'm Glenn James.